Apple reported the best June quarter in its history. Revenue 109.4 billion. Earning per share $2.02 per share. That's up nearly 29%. And gross margin, Apple crossed 50% for the first time. Sounds like a monster quarter, right? Well, yes, but not quite. Because two of those three big numbers got a little help from something Apple did not earn by selling more iPhones. It got a refund. And that little detail changes the story quite a bit. I'm Vikas, your host. This is what changed from VYNG. We don't chase headlines, we explain what changed. So let's make this really very simple. Three things happened. Number one, Apple beat expectations on revenue. Number two, Apple beat expectations on earnings. And number three, gross margin crossed 50%. Amazing. But here is the catch. Apple says roughly 2% points of gross margin and 11 cents of earnings per share came from tariff refunds. In other words, Apple had already paid those duties, and then some of that money came back. That's real money. But it's not money Apple made by selling another iPhone. Take that refund away, and earnings fall from $2.02 per share to about $1.91 per share. The earning beat goes from roughly 7% to just 1%. And gross margin goes from just over 50% to about 48.1%. And here is the really interesting part. Back in April, Apple told investors to expect gross margin between 47.5% and 48.5%. The midpoint, 48%. So Apple delivered 48.1% without the refund. So underneath the headline, Apple basically delivered exactly what it said it would. That's not bad. Actually, it's pretty damn good. But it's also not the blowout the headline makes it sound like. So, what actually changed? Let me give you a simple example. Imagine you are a delivery driver. You just had the best week of your life. Your bank account shows more money than ever before. You would probably thinking, wow, I must have delivered a ton of packages. But that's not what happened. You delivered roughly the same number of packages. The difference? A speeding ticket you paid months ago was overturned and you suddenly got the money back. So your bank balance looks amazing, but your actual business didn't suddenly get better. That's basically Apple this quarter. The refund made the numbers look better, but the underlying business was much closer to what Apple had already promised. And that brings us to the second part of the story. Because Apple is not just one business anymore. There are really two Apples. There is the hardware business, iPhone, Mac, iPad. These businesses can be pretty cyclical. People uh, don't necessarily buy new iPhone every year. For me, myself also every 2 to 3 years, I wait for new iPhone to buy. So then there is a service, the App Store, cloud, subscriptions, payments, and this is the really juicy part of for the investors. Service has much higher margins, around 76% gross margin, compared with roughly 40% for hardware. That's why investors have increasingly started looking at Apple like a software company and not just company that sells phones. Service is only about 28% of Apple's revenue, but it generates roughly 42% gross profit. That's huge deal. And this quarter, services grew 12.1%. Last quarter, 16.3%. Apple itself had guided for roughly 16% growth. So services slowed down. and it actually missed Apple's own guidance. That's the only major line in the quarter that did that. And there is another detail I think investors should notice. A year ago, services represented about 47% of Apple's gross profit. Now it's around 42%. So the high margin part of Apple, the part investor really love, is growing more slowly than the company overall. That's worth watching because for years, the services story has been one of the biggest reasons investors were willing to pay a premium for Apple. Now, here is the interesting part. Here is where Apple's next quarter gets really important. Apple expects revenue growth of roughly 9 to 11% next quarter. Analysts were expecting around 12%. So we are talking about a pretty meaningful slowdown from roughly 16% growth now to around 10% growth. That's a big step down. But here is the thing. This isn't because people suddenly stopped buying Apple products or iPhones. Management actually said demand remains strong. The problem is Apple can't build enough of them. Apple is dealing with shortages of memory chips and processors. And management said those shortages are expected to get worse next quarter. Tim Cook described it as an industry wide shortage of advanced chip making capacity. And that creates a very different problem. If demand falls, you have a demand problem. But if demand is strong and you simply can't make enough products, that's a supply problem. Supply problem can eventually be fixed, but they are also completely outside Apple's control. And that's why the next quarter could get interesting. Now, let's talk about something that doesn't usually make headlines: inventory. Normally, if a company's inventory suddenly doubles, you get worried. It can mean products are not selling. But Apple is different. Apple has historically been extremely good at keeping inventory low. And this quarter, inventory nearly doubled. It went from $5.7 billion to $11.1 billion during the fiscal year. And in just this quarter, inventory jumped about 64%. That's huge. But I don't necessarily think it's bad. In fact, I think it makes sense when you look at everything else Apple is telling you. Apple says chip shortages are getting worse. Apple says it needs to prepare for the autumn product launches. And now we are seeing Apple build up inventory. So this could simply be Apple saying, okay, we know supply is going to get tight. Let's get the components before we need them. Think of it like filling your garage before a storm. You are not doing it because you are in trouble. You are doing it because you know something might be difficult to find later. So, right now, the inventory number actually supports Apple's explanation. But there is another number on the balance sheet that I find much more interesting. And honestly, this is the one I want investors to watch. The Apple's $9.2 billion question. Apple's intangible assets increased from roughly $11.1 billion to $20.3 billion over 9 months. That's an increase of about $9.2 billion. And now here is where things getting interesting. We don't know exactly what those assets are. Apple has not disclosed that yet. So I want to be very clear here. This is an inference, not an confirmed fact. But the shape of the numbers raises a question. You have got a large increase in assets. You have got a large increase in long-term liabilities, but you don't see a matching amount of cash leaving the business. That can happen when a company gets access to something roughly a long-term commitment. rather than paying for everything upfront. In simple English, think about renting instead of buying. And that becomes interesting when you remember what Apple showed us at its developer conference: a rebuilt Siri and AI models from Google. So there is a possibility that Apple is effectively getting access to AI infrastructure or capabilities through long-term arrangements rather than building everything itself. Again, we don't know that yet, and we don't want to comment on these. However, we are just taking it as an interference. So the next filing should be telling us more about this. But if that's what is happening, it changes the way we think about Apple's AI strategy. Maybe Apple is not spending less on AI because it found a cheaper way to build everything. Maybe Apple is spending less because it's renting some of the engine instead of owning it, and potentially renting it from a company that competes with Apple. That's a fascinating story. This is why Wing's first published report on Apple has given a score 6.6 out of 10. And we are not pretending we have some magical historical scores. So we are starting it with 6.6 out of 10. And why? Because Apple is still an incredible business. Think about the scale: more than $109 billion of quarterly revenue, revenue growth of around 16%, China revenue up nearly 22%, and net cash almost doubled to around $62 billion. But we are also seeing some cracks in the story. The headline earnings beat was helped by Refund. Services growth is slowing. Next quarter guidance is below expectations, and we have roughly $9.2 billion of new intangible assets that we can't fully explain yet. So, 6.6 out of 10. Again, not a buy or sell recommendations, just our view on how much confidence the current evidence deserves. So, three things we are watching next. Number one, services. Does services growth accelerated again? One weak quarter could just be noise. Two weak quarters, now we have a trend. And if that trend continues, investors may start questioning the premium valuation Apple has enjoyed. Number two, that $9.2 billion, what exactly is it? The next filing should give us more information, and this matters because if it's a simple long term license, that's one story. If it's much larger strategic commitment, that's a very different story. Number three, inventory. Apple has built up a lot of inventory. Now, we need to see whether it actually converts into sales. If those products fly off the shelves during the autumn launch, Apple made the right call. If inventory is still sitting there a few months from now, well, then we have a different conversation. And there's one more thing. This was Tim Cook's final earning report as a CEO. John takes over on September 1, which means the guidance Tim Cook just gave is the first big test John inherits. That's going to be worth watching. So, here is my takeaway from Apple's quarter. So, this was not a blowout and it was not a bad quarter either. It was a very good quarter for a very good company. Apple basically delivered what it promised. Then it got a little extra help from tariff refund. But the more interesting story is what's coming next. Growth is slowing, services is slowing, supply is getting tighter, Apple is building inventory, and there is a $9.2 billion question sitting on the balance sheet that we don't have the full answer to yet. That's the stuff I care about because investing is not really about asking, was the quarter good or bad? The better question is, what changed? And that's exactly what we are trying to answer here. If you want to see every chart, source, calculation behind today's analysis, you will find the full research report on vyng.io, vyng.io. The link is also in description. Everything is sourced directly from Apple's filing. And whenever we are making an inference rather than the reporting a confirmed fact, we tell you, because trust isn't built by sounding confident, it's built by showing you work. I'm Vikas. This has been what changed from Wing. We don't chase headlines, we explain what changed. Clarity, not clutter.